Comprehensive market review: gold, silver, and the Hormuz geopolitical crisis. In the current financial landscape, precious metals are undergoing a fascinating and highly unusual market phase. Traditionally viewed as the ultimate safe havens during times of international conflict and economic uncertainty, gold and silver are currently buckling under the pressure of surging bond yields. Instead of rallying on the back of escalating geopolitical tensions in the Middle East, these metals are rolling over, offering virtually no sign of the haven demand that investors typically expect during crises. This extensive review analyzes the underlying causes of this anomaly, breaking down the geopolitical triggers, the resulting macroeconomic chain reactions, the shifting asset correlations, and the critical technical levels that traders must watch. The geopolitical catalyst: escalation in the Strait of Hormuz. The primary catalyst for the current market volatility stems from severe geopolitical developments that unfolded over the weekend. The tension has centered around the critical shipping lane of the Strait of Hormuz, elevating the risk of a massive global energy supply shock. U.S. President Donald Trump has issued a strict 48-hour ultimatum, threatening to obliterate Iranian power plants if the Strait of Hormuz is not fully reopened. In direct retaliation, Iran has issued stern warnings that, should the U.S. carry out its threat, Iran would officially shut the strait and launch targeted attacks against U.S.-linked energy infrastructure across the Gulf region. According to market analyst David Scott, the true danger to the markets does not merely lie in the closure of the strait itself, but rather in the amplification risk of what happens next if these threats are executed. If Iranian retaliation is aimed at key energy and social infrastructure, it raises the terrifying prospect of widespread and lasting disruptions to energy production. If the actual supply and production of energy are hit directly, the navigability of the shipping channel becomes a secondary concern compared to the global shortage of oil and gas. The economic chain reaction: yields, inflation, and the US dollar. The threat of such a massive disruption to global energy supplies has immediate and severe economic consequences. Markets are incredibly sensitive to these types of shocks, a reality that was previewed last week when damage to a major gas facility in Qatar triggered a sharp repricing in global short-end interest rates. This geopolitical standoff feeds directly into inflation and rate repricing. The elevated risk of a major energy supply disruption naturally lifts global inflation expectations. As investors anticipate higher inflation due to soaring energy costs, bond markets react violently, putting significant upward pressure on yields further out the curve. This macroeconomic environment is deeply hostile to precious metals. Late last week, gold and silver were hammered as bond yields soared, and the US dollar rebounded. Because gold and silver are priced in US dollars and offer absolutely zero yield to the investor holding them, a stronger dollar and surging bond yields inherently undermine investor demand for these assets. Any similar or larger hit to energy supply moving forward risks reinforcing this exact same yield-driven pressure, ensuring that inflation and yield pressures remain the dominant drivers of metal prices. A paradigm shift: metals trading as risk assets. One of the most striking observations in the current market environment is that price action in gold and silver is tracking equities, not haven demand. The metals are fundamentally behaving more like riskier asset classes, sliding directly alongside equities as overall market volatility picks up. This paradigm shift is heavily reinforced by recent correlation matrices. Over the past week, gold has exhibited a much stronger relationship with US stock futures, a correlation that almost perfectly matches the strength of its inverse relationship with US two-year yields. While both of these economic links can ultimately be traced back to the extreme volatility in energy prices, the data clearly indicates that broad risk appetite is currently playing the most significant role in gold's valuation. Furthermore, analyzing the relationship between gold and market volatility tells a similarly bearish story for haven seekers. Gold currently holds only a very weak inverse correlation with VIX futures, displaying absolutely no real signs of behaving like a traditional safe haven asset. Understanding this correlation is vital for interpreting price action moving forward. If broader equities manage to stabilize or push higher, it significantly increases the chances that gold will find support. Conversely, if overall risk sentiment deteriorates further in the face of conflict, precious metals are left highly vulnerable to further downside. Technical analysis: gold's bearish breakdown. From a technical perspective, the charts reflect the intense fundamental pressures weighing on gold. The sell-off in gold significantly accelerated following a decisive break below its 50-day moving average, 50 DMA. Losses picked up noticeably after the price broke and closed beneath this critical level on Wednesday. Importantly, the bullish sequence of higher lows that gold had maintained following its late January rout has officially ended. On Friday, gold broke and closed beneath a major uptrend support line that had been firmly in place since late October of last year. Looking at downside risks, the key level to watch is $4,405, a price point that has previously acted as both support and resistance. If the $4,405 level gives way, it could trigger a deeper cascade, bringing $4,245, $4,150, $4,100, and eventually the 200 DMA into view, alongside longer-term structural uptrends that have held for years. Momentum indicators strongly favor the bears. Both the RSI 14 and the MACD are trending lower and continue to flash clear bearish signals, indicating that traders should favor downside setups over topside plays. However, traders must remain cautious of near-term pullbacks. The widening Bollinger Bands suggest increased volatility, and because the price of gold is currently sitting beneath the lower Bollinger Band, there is a clear and present risk of a short squeeze. If gold sees a move back toward the October uptrend line around $4,665, price action at that specific level will be highly instructive. A clear rejection at $4,665 would favor renewed downside momentum, while a break back above it would cast serious doubt on whether a more extended bearish trend is truly developing. Technical analysis: silver's downward flush. Silver's technical posture, unsurprisingly, paints a very similar picture to gold on the daily charts. Silver experienced a harsh breakdown on Wednesday when it fell beneath a critical support zone. This zone was comprised of the 23.6% Fibonacci retracement of the January-February high low at $77.68, combined with horizontal support at $78.25. Falling through this floor paved the way for an accelerated downward flush over the remainder of the week. Bearish momentum in silver is strongly confirmed by technical oscillators. While the RSI 14 is trending lower, it is not yet officially oversold, leaving room for further drops. Additionally, the MACD has flipped negative after crossing its signal line from above. These factors provide clear confirmation of a bearish bias, favoring a strategy of selling into strength. The immediate downside reference for silver is a major confluence zone consisting of the February lows at $64.10, horizontal support at $64.65, and an uptrend line established in August of last year that currently sits around $63.50. This August uptrend previously acted as a strong base of support before silver's massive rally late last year and has gone untested since, making it a highly important zone for assessing medium-term directional risks. Below this crucial confluence, there is only a string of minor support levels before the 200 DMA comes into play. On the top side, true resistance is found back in the high 70s, where last week's breakdown originally began, making the recent fortnight's downtrend more of a minor reference point than a formidable ceiling. Similar to gold, silver is currently trading beneath its lower Bollinger Band, which points to an increased risk of a near-term short squeeze and makes it dangerous to chase the downside aggressively at current levels. Conclusion and risk disclaimers. In conclusion, the intertwining of the escalating Hormuz crisis with shifting macroeconomic realities has fundamentally altered the behavior of precious metals. The threat to global energy infrastructure has sparked fears of lasting inflation and surging bond yields, stripping gold and silver of their safe haven status and forcing them to trade in tandem with risk-on equities. Until energy markets stabilize or the correlation between metals and risk assets breaks, gold and silver remain highly susceptible to further downside flushes. It is important to note that trading these volatile markets carries immense risk. According to Forexcom, operated by StoneX Europe Limited, contracts for difference CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage, and 77% of retail investor accounts lose money when trading CFDs with this provider. Traders should carefully consider whether they understand how these instruments work and whether they can afford to take the high risk of losing their capital.